Hey everyone, my name is Ben Consoli. I work at CVF Capital Partners. I'm an analyst there. So kind of my day-to-day is, analyzing new deals, coming up with discounted cash flow models as well as LBO models and that kind of sort. So I went to Cal Poly San Luis Obispo. I graduated in 2019 and immediately joined at CVF Capital Partners, and it's been an awesome experience since then. So today, I'm going to be teaching you guys a little bit about discounted cash flow models, otherwise termed DCF, why it's used, the different types of DCF models. There's two different types, which we'll touch on. And then we'll also build one out together. So with that, let's kind of just jump in. So the very basics of a discounted cash flow model is, you're trying to arrive at what the fundamental value of a stream of cash flows is. Because a company, generates cash flows, or at least is expected to, we use DCFs to arrive at, a fundamental value of an overall business. And typically what that translates into is a price of the stock. So if you had, just the stream of cash flows above, what would you do and how would you value it? What would it be worth today is ultimately the question that you're trying to arrive at using a DCF. It definitely wouldn't be, 20 plus 15 plus 25 plus 30, because there's something called time value of money. So if you give your friend $80 or whatever it is, you want more than that back, because, you could have used it yourself to consume today rather than lending it, or you could have, spent it later when you got it back. But later likely would have been worth something else. So you could have invested that money into a new venture, real estate, investments, anything of the sort, and earn more dollars back than what you invested. Hence, there's something called the time value of money. As is well known, the time value of money compounds over time. As such, one, should discount the future cash flows by what the return they need to convince them, not to use the money today or for other purposes. So what's embedded in a discount rate is one, the risk-free rate, certainly, which is typically represented by the 10-year treasury rate, because it is, in theory, risk-free, given, it's backed by the US government. On top of that, on top of the risk-free rate is a, risk premium associated with the risks of the cash flows. So if a cash flow, is less certain, then you should be compensated for, taking that higher risk, and hence warrants a higher discount rate or, a rate of return. So that's generally what a DCF is. And now we'll, touch on how and why it's used. So starting kind of with why it's used. It's used, to make investment decisions. So whether to buy a stock or sell a stock, whether to take on a capital project or not take on a capital project, that kind of stuff, or whether, short a stock or something like that. Most short sellers don't do it just based on valuation, but some do. So another reason that it's used is to understand, expected risks and returns. So you can see that the current discount rate for the cash flows that people are projecting is this. If you think that doesn't take into consideration all the risk, then you should sell it. Otherwise, you should buy it. So who is it used by? It's used by hedge funds, valuation experts, private equity, venture capital, corporate finance, corp dev, equity research, you kind of name it in the finance world, it's being used. So, across the entire finance industry, it's used very broadly. There's always, alterations as to how it's used. Some people just project out 1 or 2 years and then discount back. Some people project out 5, 10, 15 and discount those cash flows back. So within these, different industry verticals within finance, it's used differently. And it's used to different extents within those different, subsectors. So how is it used? The way that you want to think about it is the present value of the cash flows is greater than the current price of the security. So say, to you, the cash flows that this company is going to produce discounted back to today is greater than what the price of the stock implies, and you want to buy the security. You want to sell the security if the present value of the cash flows is below the current price of the security, and then if it equals, then you're being compensated correctly based on the risks of the current investment and the cash flows. So that's how and why it's used. Let's kind of dive into two different types of discounted cash flow models. So there's two different types. One essentially values enterprise value, and one values the actual equity value of the company. So you can use the free cash flow to firm, which values enterprise value, and then from there you can back into equity value. But let's just start going through with the free cash flow to the firm. So what does the free cash flow to the firm get you kind of as an output? It gets you the enterprise value of the company, which you can think of as the value of the entire company as a whole. So that would be, the worth for the creditors as well as the equity investors. So what is it solving for? It's solving for cash available to both of the creditors and the equity holders, because it is the enterprise value of the company. So what does free cash flow to the firm formula actually look like? So it's cash flow from operations minus CapEx plus interest expense multiplied by 1 minus the tax rate. So you get a little bit of a tax shield from the tax rate. So from there, once you discount back, the discount rate that you're using is the weighted average cost of the capital. So when you're putting together the discounted cash flow model, you'll get all the cash flows using the free cash flow to the firm calculation there, and then you'll discount back using the weighted average cost of capital. So what the weighted average cost of capital is essentially a weighted average, as implied, between the cost of equity and the cost of debt. So your cost of equity, as we'll touch on to the right, is essentially dictated by the capital asset pricing model. So CAPM, which we'll talk about in a second, to the right. And then the cost of debt is essentially just your interest rate on the debt. So what is the IRR on the debt given the current price and the cash flows that you have to pay to your creditors. So the weight of the equity is the market value of the equity. So remember that it's market value of the equity, not the shareholders' equity on the balance sheet. So the market value of the equity plus, or divided by the market value of the equity plus the market value of debt. So MV means market value. And again, that's market value of debt, not the balance sheet balance of the debt. In the example that we'll do, we'll use just the balance sheet value of debt, but in reality, you want to be using the market value of debt. So then vice versa, the weight of debt is market value of debt divided by market value of equity plus market value of debt, so that you get the weight of the debt and the weight of the equity. And so then the weighted average cost of capital is just the weighted average of those two. So weight of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. And that's again, because your tax rate decreases the volatility of your debt, so that the cost of debt decreased. It's also because you get a tax shield from that debt. So you really don't have to pay the entire interest amount. It's deductible. So that way, the cost of debt is actually lower than what the interest rate is. And then you'll take the weight of equity multiplied by the cost of equity to arrive at the total weighted average cost of capital, which you're discounting the free cash flows to the firm back to the enterprise value. So now for the free cash flow to equity, it's very similar to the free cash flow to the firm, but the output is equity value rather than enterprise value. So what equity value is enterprise value minus debt. So that's the cash, that's the value of the debt today, plus the cash on the balance sheet today. So that's how you get to equity value from enterprise value if you're doing the free cash flow to the firm. So what it's solving for is the cash available purely to the equity holders. So free cash flow to equity equals cash flows from operations minus CapEx plus net debt issued. So if you're issuing debt in a year, then that cash is technically available to the equity holders. But also, if you're paying down debt in the sense of principal payments, then you're essentially paying down debt, which that means that there's no longer that cash flow available to the equity holders. So any payment of debt that you're doing, paying back of debt, you have to take into consideration there. So the discount rate that you're using is the cost of equity, like we talked about briefly. That's the capital asset pricing model. So you have your risk-free rate, which again we talked about earlier, which is typically denoted as the 10-year US Treasury rate, because it is in theory risk-free. And then you have beta, which is essentially the volatility of the current stock price around what's the market price. So it measures how sensitive is the current stock compared to the market. So companies that have higher volatility than the overall market have a higher beta. So think technology stocks tend to move more than Coca-Cola or anything like that. So you have your beta multiplied by the equity risk premium, which is just essentially the expected return above the risk-free rate for the market. So that's the two different types of discounted cash flow models. What are the components within the DCF? So one, you project out all financial statements for the next 5 years. Typically it's 5 years. It's just kind of industry standard, but there's variations to that depending on what your holding period is and stuff like that. So you project out the income statement, balance sheet, statement of cash flows, which you guys did in the previous homework. So we're going to be working off of that. And then from there, you have to discount free cash flow or free cash flow to equity using the appropriate discount rate, which again, we touched on the last one, is either the weighted average cost of capital if you're using the free cash flow to the firm, or the cost of equity if you're using free cash flow to equity. From there, you're either going to arrive at the enterprise value if you're using free cash flow to the firm, and you have to convert that to equity value using the formula we talked about before, which is just enterprise value minus debt plus cash. That's a simple version of enterprise value. There's more detail to that, but you guys don't need to know the nuances at this point. Or you'll directly arrive at equity value using free cash flow to the equity holders. And then from there, what you do is you now have the total equity value of the firm, and you have to convert that to a per share price by dividing by the total number of shares outstanding. An alteration to that is if you want to be valuing each of the cash flows in the future on a per share basis, you can do that. So if you're using the free cash flow to the equity, then you can just be dividing each cash flow by the number of shares outstanding in that year and discount those free cash flows to today, and you'll arrive at the free cash flow, or you'll arrive at the price per share today. So with that, let's kind of turn to the exercise that we're going to do. Here are some instructions for the homework that's going to be left over, which is just recreating what we're going to walk through now. So with that, let's turn to the discounted cash flow models. So we're going to start with a completed discounted cash flow model. Actually, let me just make sure I'm sharing. Okay, so here is the prior homework that you guys did. So what you'll do is you'll just input or copy over this tab and this tab into your prior homework, and we can go from there. So as you guys did in your prior homework, you projected out all the financial statements. So the income statement, balance sheet, cash flow statement, and then debt schedule and PPE schedule. From there, what you're going to do is let's start with the free cash flow to equity discounted cash flow model. So what we'll start with is step one. So free cash flow to equity calculations. So like we talked about, there's an easy way to get to free cash flow to equity just directly from the cash flow from operations. But there's also a couple other formulas that you guys should know how to get to free cash flow to equity from net income as well as EBIT. So we'll start with free cash flow from operations. So you start with cash flow from operations and you're grabbing that from your financial statement projections. And then you're subtracting out CapEx and you're adding back net debt issued. So all three of these you can just grab from the financial statements that you produced earlier, which you'll see the net debt issued includes principal payments as well as debt issued in the year. So you're looking at D94 and D95 for the year, which you'll see is right here, D94 and D95. So you see that you're paying down the revolver, 1.3 million, and paying down the long-term debt, so amortizing debt at 500,000 per year. My understanding is everybody's projections are going to be a little bit different, so you're going to get different per share prices. So there you go. That's how you get to free cash flow to equity from the cash flow from operations. Now we can kind of turn to how to get it from net income as well as EBIT. So from net income, it's essentially you're just going to try to get back to cash flow from operations, which starting at net income, you're just going to add back depreciation and amortization, and you're going to subtract out changes in working capital, and that gets you to cash flow from operations here. And then again, it's the same thing below. So CapEx minus CapEx plus net debt issued. So as you know, any increases in net working capital is a negative to the firm because you're extending, say your AR is not paying you currently or quicker than you're paying AP. So you're not getting as much cash in from your working capital as you are paying out at the time. So that's how you get to free cash flow to equity from net income. And then we can go to free cash flow starting from EBIT. So again, you're trying to just get to what is cash flow from operations at that time. So for year 23, you're starting at EBIT. To get from EBIT to cash flow from operations, you have to subtract out interest as well as taxes. And that will get you obviously to net income. And then from there, you have to make the non-cash adjustments that are on the income statement, which is adding back depreciation and amortization. And that's amortization of goodwill, not amortization of debt. And then you got to subtract out any increases in working capital, subtract out CapEx, and then add back any net debt issued. That's how you get to free cash flow from equity, starting from EBIT, net income, as well as cash flow from operations. Overall, the easiest way to think about it is just get to cash flow from operations, and then from there you're going to use cash and CapEx. So subtract out that cash that you're using, and then you're also going to usually you're going to be issuing debt and you're going to be paying back debt. So any issuance of debt increases your cash flow to equity holders because it's now on the balance sheet, and the equity holders technically own a portion of it. And then sometimes you're going to be paying down debt as well, which is a use of cash that the equity holders don't get the benefit from. So that's how you get to free cash flow to equity. Here you just want to check that all the calculations match above. So that way you can confirm that you did all three calculations correct. If this is green and says true, then you didn't correct. If it's not, then you didn't do it correct. So from there, you have all the free cash flow to equity that is occurring throughout the investment period. And then when you sell the stock, say if we're valuing stock, then you're going to get a cash flow at the end of the investment period as well. So what you have to do is back into the equity value when you plan to sell. For most publicly traded stocks, here the easiest way to think about it is price to earnings, which is just net income per share multiplied by the price to earnings multiple. In this case, we're going to be arriving at the equity of the entire business. So that's going to be the equity value of every shareholder, and then later we're going to get to the equity value per shareholder. So you start off with net income for the entire firm, multiply it by the price to earnings ratio, and that gets you to the equity value of all the entire firm. So the price to earnings ratio obviously is dictated by industry multiples. Typically, what's embedded in the multiple is the growth prospects, management team, stuff like that drive value over time. So companies that have a higher growth trajectory should, in theory, have a higher multiple than something that's steady state, because there is the opportunity to grow. So from there, you're going to go into step 3, which is just calculating the discount factor that we talked about. So since we're doing right now the free cash flow to equity, we're going to be looking for the cost of the equity for the company. And again, that starts with the equity risk premium. So you can get a lot of the data, true data based on, industry and stuff like that for the equity risk premium, beta, and risk-free rate using this website link here. It's a great way to understand the different, betas for industries as well as equity risk premiums. The risk-free rate for basically all domestic companies is going to be the same, since risk-free cash flow is the same no matter what company that you're looking at. And then the equity risk premium is obviously going to change as well as the data. And so from there you have, sorry, I take that back. Equity risk premium is for all domestic companies should be the same, given it's the equity risk premium of the market, and then beta adjusts that equity risk premium based on the volatility of the stock. So again, the formula is equity risk premium multiplied by beta plus the risk-free rate. So that's how you arrive at this 14.6 number. In this case, it's all the same because we kept it simple and left the risk-free rate the same for the entire period, but often the risk-free rate is different based on the year, as well as the equity risk premium is different too. So sometimes this cost of equity will change over the investment horizon, and then for that reason you have to change these as well. So the cost of equity, to go from the cost of equity to the discount factor, you have to take into consideration how many years into the investment are you. So, a cash flow that occurs in year 2023 compared to a cash flow that occurs in year 2024 has a different discount factor, because again, the discount rate compounds. So if you're going to have, a $10 cash flow in year 1, that should be worth more today than having a $10 cash flow in year 2, because you have to wait more time to get that cash flow back. So you're not spending today and you're not spending that capital in year 1 as well. So the discount factor is simply the 1 plus the interest rate raised to the number of years, so time since the investment. So you can see here, the discount factor is greater as you go through time, holding the cost of equity constant. From there, now you have the discount factor and you have the cash flows for the equity holders. And now you can arrive at the discounted cash flows using the discount factor. So here you're just culminating all the equity cash flows, which again, you calculated above. You have to make sure to include the terminal value of the cash flow, because you're going to get that when you sell the stock in theory. So you culminate these into total cash flows, and then you discount those back to today. So you can think of, $1 million or $1,089 discounted back to today using the discount factor of 1.15. All you do is divide that equity cash flow by the discount factor to arrive at what its value is today in today's dollars based on the discount rate that you're using. So you're going to do that for the free cash flow to the firms, or free cash flow to equity holders, as well as the terminal value for the equity holders as well. And you're going to culminate that into the discounted value of all the cash flows to the equity holders. So from there, you're going to come to the total equity value of the company, which is just the sum of all these cash flows. And that's going to get you, again, the holistic picture of what the equity value as a whole is today. From there, you have to convert that to a per share price, which to do that, you have to divide the total equity value simplistically. You have to divide the total equity value divided by the number of fully diluted shares outstanding, which in this case is 1,000. So you divide the total equity value of 54,606 divided by 1,000 gets you to $54.61 per share. Something I should have mentioned earlier is anything in blue is a hard code, which means that it's physically just a number in there. Anything in black is a formula. So anybody that's putting together any models in the future or anything like that, that's typically the standard in the industry. Is anything in blue is a assumption or a hard code input, and anything in black is a formula. It just makes it a lot simpler for when you send the spreadsheet to your managing partner, they can follow along pretty easily and think, okay, this is an assumption versus this is a formula. I shouldn't mess with the formula, but I can change the assumptions. So something else I probably should have mentioned at the beginning is based on your homework, it looks like today is December 31st, 2022. So the first year of the investment is going to be 12/31/2023. So with that, we covered free cash flow to equity and using a DCF to get back to the equity value per share. Now we'll turn it to the free cash flow to the firm and back into how to arrive at the free cash flow to equity, or the purchase price per share. So now we're starting at the free cash flow to the firm. So again, we'll start with the same step one, which is calculate the free cash flow to the firm from cash flow from operations, net income, and EBIT. I'll just go through the cash flow from operations on this one, just because it's repetitive once you understand free cash flow or cash flow from operations to go through net income and EBIT. It's just repetitive because what you're doing again is just arriving at cash flow from operations and then making the adjustments. So starting from cash flow from operations, what you're going to do is subtract out CapEx, and then you're going to add back the interest expense multiplied by 1 minus tax rate. So the reason that you're adding it back is because you're valuing the entire enterprise value using the free cash flow to firm. And because of that, you're also taking into consideration the cash flows that are available to the credit holders. So the credit holders are the people that are charging you interest. So you want to add that back from cash flows from operations because cash flow from operations already deducts that. So you have to add it back to get the cash flows that are available to both credit holders and equity holders. So that's the free cash flow to firm starting from cash flow from operations. From there, and again, go through it all, make sure it's all calculated correctly, make sure this is true. From there, you're going to look at the terminal value of the firm when you're selling the investment. So again, you're going to get a cash flow when you sell the investment at some point. So typically, the easiest way to go for a enterprise value is use a denominator that is available to all equity holders and credit holders. So the easiest one to think about is EBITDA. That's kind of the industry metric that a lot of people use. So EBITDA is, again, earnings before interest, tax, depreciation, and amortization. So you're not subtracting out interest, and depreciation and amortization is a non-cash expense. So you're using EBITDA because that's available to both creditors and equity holders. From there, you're multiplying by, the industry EBITDA multiple, which is, in this case, 10 times, and that's going to get you to your enterprise value, which, again, like I mentioned, is the entire value of the company. So from there, you'll get, your enterprise value for the company. And for step 3, then you go into calculating the weighted average cost of capital. Sorry, this is spelled wrong. So what you have to do, like we talked about, is arrive at the weight of equity as well as the weight of debt. So what you have to do is you have to get the market value of the equity at every point in time, so that you understand what the weight of the equity is compared to the market value of debt. So again, to arrive at enterprise value and then get down to equity value, you start with EBITDA multiplied by multiple, and that'll give you enterprise value. From there, the formula to get to equity value is you add back cash, subtract out the debt on the company, which again you're just grabbing off the balance sheet in the financial statements prior homework, and you're getting the cash there as well. And that'll get you to the market value of the equity at that point. And so then from there, you can understand, okay, the weight of the equity value is the market value of the equity divided by the market value of the equity plus the market value of the debt. So then you do the reciprocal for the weight of debt, and you'll get 7.6% and 92.4%. for this current circumstance. Obviously, for your homework, it's all going to be different because everybody has, different assumptions in blue as well as different EBITDA. Same with different cash and different debt. So now we have the weight of debt and we have the weight of equity. Now we have to calculate what is the cost of equity and what is the cost of debt. So the cost of equity, which we touched on in the last one, is just the equity risk premium multiplied by the beta plus the risk-free rate, and that gets you to your cost of equity. To calculate the cost of debt now, again, there's a tax shield on the interest rate. So what you do is you multiply the debt interest rate, so that's your current prevailing interest rate. In reality, you want to use the entire cost of debt. So if there's a discount or something along those lines, you want to use the debt interest rate. And then you want to multiply by 1 minus the tax rate, and that'll get you to this 5.2 number. In this instance, I wanted to show you guys exactly what the interest tax shield is. So what you do is you just multiply 8% multiplied by the tax rate, and you'll see that that is the tax rate shield. And in this case, it's 2.8% because the tax rate is 35%, 35% of 8 is 2.8. And so you'll get to the cost of debt after taking into consideration the interest tax shield of 5.2%. From there, you have to calculate the weighted average of the cost of capital. So what you want to do is you want to take the weighted cost of debt plus the weighted cost of, the weighted cost of equity plus the weighted cost of debt, which in this case is just going to be the weight of equity multiplied by the weight or the cost of equity, which will get you to 13.5 in this circumstance. And then you want to take the weight of debt multiplied by the after interest tax shield cost of debt. So 7.6 multiplied by 5.2. And when you add these together, that'll get you to the weighted average cost of capital for the company. And you'll see that over time, this changes. In this circumstance, because the weight of debt is going down, the overall weighted average cost of capital is going up because the interest rate of, the cost of equity is greater than the cost of debt. Because the cost of equity is becoming a higher portion of the overall capital stack, then you have a higher weighted average cost of capital. So from there, we're going to repeat again what we did in the prior version, which is just come to a discount factor. So your total cost of capital equals the weighted cost of capital in this instance. And again, you just get to the discount factor using the number of years that you've been in the investment. And then finally, the last step in this instance is to discount the free cash flows to the firm using the discount factor. So you just use here you just culminate the total cash flows to the firm, which includes the terminal value of the cash flows to get to the total cash flows of the company. And then from there, you're going to discount those back using the discount factor. So you just divide the free cash flows to the firm divided by the discount factor, and that'll get you the present value of the free cash flows to the firm. When you culminate all of these discounted cash flows to the firm, you're going to be getting the enterprise value. So you'll see the enterprise value is just the discounted value of all those cash flows. And then again, like we talked about, what you're going to have to do from there is convert the enterprise value to equity value. And how you do that is adding cash, because that's available to the equity holders. And then you subtract out net debt, or you just subtract out debt. And that'll get you market equity value of all the cash flows. From there, you can divide by the fully diluted shares outstanding, which again, in this case is 1,000. And you're going to get at a per share price of 54.51. So you'll see once you build out the financial statements like you guys did in the last homework, it's quite straightforward to get to to build out a discounted cash flow model. You want to make a decision as to whether you want to go with the free cash flow to equity versus the free cash flow to the firm, and that's just subject to really kind of taste, and often people will use the free cash flow to the equity holders if there's going to be a lot of change in the debt, or if there's issuance of new shares and stuff like that. So that's kind of the culmination of using a discounted cash flow model. I'll send over an email, my email, if you guys have any questions or anything like that you want to follow up on. Awesome. Thanks, everyone.